Joining us right now is S&P Global Portfolio Manager Erin Gibbs. Erin, good to see you.
Thank you.
You like this market after the sell-off that we've seen?
Yeah, I do. Well, one, it's more fun when things are happening. I mean, going up is great. Yeah, when things are going up. But two, yeah, we really do like this market. When we started the year, we were really concerned about valuations. Stocks were very expensive. It was hard to find something that was reasonably priced, that looked like you were getting in at a decent price. Right now, the forward valuations in the S&P 500 are actually below the 3-year average. So for us, that's good. For us, it's, we're no longer at our peak, and actually there's some possible values you can find here and there.
And this is at a time, Gary, when earnings are supposed to be up 20% this year.
Yeah, I think it's going to be terrific earnings year, but I think the real story lately, and maybe you'd agree, this volatility is crazy. Are you worried about it, playing it, factor into your equation?
Well, when you look at the volatility historically, right now the VIX is at about 20,
right,
which is really just at levels that we saw back in 2015-16. It's just that we got used to having almost no volatility for the past 18 months, that we have very short-term memories.
Think it goes back down to those levels? I think it goes back down to that. No, you think it's here at a higher elevated to stay?
As long as we keep having these reevaluation concerns, where we keep seeing the Fed rate going up, we might stay in this more normalized range where we're going to have up days and down days, not just consistent.
Just real quick on volatility, it was so low that we. VIX was at 9. Our actual volatility was at like 4.58, and that means you were going to get a 0.3% move in daily move in the market, which is unprecedented. I mean, we hadn't had it. So this is a long time coming, because we didn't even have a move of like 3% for over 400 days.
Yeah, but when the volatility kicks up and these stocks not crater, but really drop dramatically in a day or so, are you using those opportunities to go in, or are you more long term in staking out your positions?
The money we manage is much more long-term.
Okay.
So we're not trying to just jump in. But when we do look at our asset allocation, sort of fund to funds, this is something that really excites us, particularly when we're looking at our rebalance periods and we're a lot more comfortable with the equity markets at these levels.
I love the headline we got yesterday from JP Morgan. It said month-end equity buying flows could be substantial. What does that tell you? They're seeing an enormous amount of buying flows on equities. That tells you this market's going up.
Think about the world market. I mean, we're growing in sync with the rest of the world. You have the world's largest economies from China, the United States, Europe, all growing. The leading economic indicators are doing exceptionally well, from durable goods reports, PMI reports.
Yeah.
You've got jobs numbers are doing exceptionally well. People are getting more money in their pocket. I mean, there's the fundamental underpinning of the market is there and lending credence.
I mean, all you have to do is contrast. Would you rather have this market, or would you rather have the market under Obama? Yeah. It's pretty simple, isn't it?
Yeah. The thing that I find really interesting is I spend a lot of time talking to individual investors and trying to understand what they're thinking right now. This volatility has really spooked people, especially those people who are within 10 years of retirement. And the question they keep saying is, do I need to sell now? What would I do as an individual investor that's getting closer to needing the liquidity? What would you tell them to do?
Yeah, I've had a lot of those conversations, and the one thing that we try to remind them is, look, if the closest in history that we've had something like this was a 2015 flash crash, and it was basically over in a week. 2 weeks. Yeah. So we try to remind them it's really hard to time these. Don't get out now. This is the absolute wrong time. And in fact, even in the periods where we've had these crashes, the fundamentals were much worse compared to what we're looking at. We're looking at 8%, 7% revenue growth.
Yeah,
not
that's
even
good.
That's
so 7,
really
8% revenue growth for the year.
Yeah.
And 20% earnings growth for the S&P 500 for the year. These are amazing numbers. I want to get your take on the banks, yours too, Kevin, because JP Morgan is holding an investor day. It's on Tuesday, actually. A lot of commentary this morning about it. The stock, apparently, one analyst is saying stock is at a premium. Look at that chart, but it's not a crowded trade. What would you do with JP Morgan ahead of the investor day on Tuesday?
I do like this name. I used to own it in the past. I think we're going to look at the guidance going forward. I mean, everybody's concerned about yields and actually what it's going to do in the housing market. And so that's the story that's been coming out over the last couple of days. What's going to happen to the housing market as mortgage rates go up? And can JP Morgan lend out more money? Are they going to see more mortgage applications? So that is the biggest concern coming out out of JP Morgan's Investor Day coming out next week. The guidance
pre-tax margins in 17 highest in 30+ years.
Yeah, of course, because the net interest margin is going to go up, right?
Yeah.
So that this is an underpinning that is really good for the bank. So the biggest boogeyman that everyone's worried about is what is going to happen on the mortgage side of the business. Everybody knows trading is going to be up because of volatility. Everyone knows that their net interest margin is going to go up. What's going to happen in the consumer lending side of the business?
And they've been closing branches. They're using a lot of technology as well. We'll see about that. You like the banks here, Erin?
Financials are sort of in the middle of the road for us, just because when looking at the spreads and the yield curve, that's the big unknown, and that's where you're really getting your margin. And we haven't really seen those spreads expand as much as we like. So for us, we're a little hesitant on the financials. We actually like consumer discretionary.
But you know what? Back to Kevin's point, it is impossible to not like the financials if you believe the economy is going to do well.
And deregulatory environment.
JP Morgan will find a way. Maybe it's not in lending, maybe it's in trading, maybe it's in somewhere else. Economy goes up, financials go up, period.
All right, we will leave it there. Erin, great to have your insights. Thank you so much. Erin Gibbs joining us there.